Happy Friday, IHMC friends and family. It's Shayan with Integrity Home Mortgage, back with your weekly mortgage market commentary. This week's theme was jobs, and it was not pretty. JOLTS, or the Job Opening and Labor Turnover Survey, recorded its lowest number of job openings in nearly 4 years. Payroll processing company ADP recorded only 54,000 new jobs versus a forecast 73,000. But the real headline this week was this morning's non-farm payrolls report, which was another unambiguously weak one. The U.S. economy added just 22,000 new jobs, which is well below the expectation of 75,000. This confirms the early signs of a rapidly cooling labor market that appeared in July's report. The unemployment rate ticked up to 4.3%, hitting its highest level since 2021. Unsurprisingly, the weak jobs report sent U.S. Treasury and mortgage rates lower. As I record this video, 2-year yields are matching their lowest point in 3 years, down a little over 8.5 basis points to 3.5%. 10-year yields are down about 7 basis points to 4.08%. And according to Freddie Mac, whose data is a little stale at this point, the average 30-year fixed-rate mortgage fell 6 basis points down to 6.5% flat. Today's move will undoubtedly drive mortgage rates even lower. New data and the flight to safety reaction by rates markets is a clear indication of investors' concerns around a slowing economy, and that confidence about a Fed rate cut is getting stronger and more aggressive. Voices on the FOMC had already been aligning around cuts, and now that dovish sentiment really appears to be justified. Two consecutive weak jobs reports provides more than sufficient data for a Fed that has hung its hat on being data-driven to really get back into the business of easing. In addition, we're hearing more alignment around the impact of tariffs on inflation. So while acknowledging that tariff-related price pressures are becoming more apparent in the data, many officials, including those that have been leaning more hawkish, now view these impacts as being transient and not really persistent. This distinction is crucial. This is what sets the stage for the Fed to prioritize formally its employment mandate over its inflation mandate. Next week, we'll get some important inflation data. Speaking of inflation, we'll get PPI, which is the Producer Price Index. It's a measure of wholesale inflation, and CPI, which is the Consumer Price Index, which is a measure of consumer-focused inflation. It can be argued that these numbers are maybe a little less impactful because the Fed is focused more on jobs now, but these numbers will be released far enough ahead of the FOMC meeting that it's sure to be a point of concern, or at least a point of discussion, if they continue their recent trend higher. The Fed meeting is on September 16th to 17th. And there is a 100% chance of a cut already being priced into rates markets. So if you're in the market to purchase or refi, there's really no reason to wait until the 17th. That is being priced in already. Coming into this morning's number, markets had really been fairly evenly split, like 50-50 on whether there would be 2 or 3 rate cuts in 2025. That has now shifted to about a 70% chance that the Fed will go 3 for 3 to close out the year, and there's a small but growing opinion that they could even come in with a splash and go 50 basis points to kick it off. Now, I'm not quite there yet, but I suppose it could happen if inflation data comes in super low. So this week's bottom line, weak jobs report has basically cemented expectations of a September rate cut. Lower mortgage rates are providing some refi opportunities and some much needed relief to the housing affordability crisis nationwide. And a combination of Fed comments and data has solidified essentially a new market narrative, and that is that the Fed has shifted from fighting inflation to propping up a weakening labor market. This should mean a more aggressive and sustained easing in comparison to the 2024 easing, which was gradual and like a gradual and incremental approach. This is not great news for folks that are looking for a job, but this is great news for anyone who's looking for a mortgage. That's all I got for you this week. Have a great weekend, and we'll see you next Friday.